Did you know that only around 20% of self-employed people are paying into a pension? That compares to roughly 80% of those with employers who are generally scooped up into auto-enrolment, a system that funnels money from pay packets directly into pensions, while also adding contributions from employers. Unfortunately, there's no such system for the army of freelance workers, sole traders and limited company owners who make up the UK's almost 4.4 million strong self-employed workforce. Instead, if you're self-employed, you have to go it alone, taking full responsibility for saving for your retirement, while also juggling everything else that comes with working self-employed. And of course, you don't get any contributions from an employer. Problem is, if you're not managing to put anything away, you could be storing up significant financial challenges for later. Because, as most of us know already, the UK state pension on its own isn't enough for much of a life in retirement. Now, here's the thing. According to research from Nest Insight, 3/4 of self-employed people say they actually want to save for retirement. So if you're amongst these, then you're in the right place. Hello, I'm Brian, and today with Moneyfarm, I'm going to show you exactly how to build a retirement pot when you're self-employed, including a tax advantage that most self-employed people aren't making nearly enough use of. So let's dive in. Let's start with arguably the most powerful reason to pay into a pension, and one that too many self-employed people simply aren't aware of. When you pay into a pension in the UK, the government tops up your contribution. So every time you put money in, they add a percentage on top of the grossed up figure for free. Here's what it looks like in practice. For every £80 you contribute, the government adds £20. So you immediately have £100 in your pension. Pay in £800 and you get an extra £200 on top. So that's an instant 25% boost before your investments have done anything at all. If you're a higher rate taxpayer, you'll also get another 20% back via your tax return. So that's 40%, meaning a £1,000 contribution into your pension would actually only cost you £600. And additional rate taxpayers get 25% back through their tax return. So that's 45% tax relief in total. For anyone based in Scotland, the rates work slightly differently, so it's worth checking what applies to you. Now, because of these tax breaks, there are limits to how much you can pay in and still benefit from tax relief. And this is known as the annual allowance. And for most people, it works like this. You can get tax relief on contributions up to 100% of your relevant UK earnings, capped at £60,000 a year. So if your UK relevant earnings are £30,000, you get relief up to £30,000. If they're £60,000, up to £60,000. The key phrase there is relevant UK earnings. This means things like your trading income or salary, but not dividends. So if you pay yourself mainly through dividends, as many limited company directors do, it's worth being aware that your tax relievable pension contributions are based on the salary portion of your income, not the full amount that you take home. And as always, there are a few things to be aware of. Number one, this isn't just a SIP annual allowance. The annual allowance relates to all pension contributions from you and your employer into any pension you have, not just a SIP. Number two, there's something called the carry forward rule, which can allow you to take advantage of any pension allowances you didn't use from the last 3 tax years. Now, this is especially useful if your income varies. So if you had a quieter few years and didn't pay much into your pension, a stronger year gives you the chance to catch up. But there's one thing worth understanding clearly. Carry forward doesn't mean you can contribute unlimited amounts just because you have unused allowance sitting there. Your total pension contributions in any given tax year still can't exceed what you actually earn that year. So, for example, if you earn £50,000 this year, that's your ceiling for tax relievable contributions. So even if on paper you have £80,000 of unused allowance carried forward from previous years, you'd only be able to use £50,000 of it. The flip side is that in a genuinely high earning year, carry forward can be a powerful tool, as it lets you pay in significantly more than the standard £60,000 annual allowance. Number 3. Higher earners may find their annual allowance reduced under something called the tapered annual allowance. In simple terms, it's a rule that gradually reduces your annual allowance the more you earn. So instead of the standard £60,000, you might find you can contribute significantly less before losing your tax relief. It kicks in when 2 conditions are both met. Your threshold income is above £200,000, and your adjusted income, which includes things like employer pension contributions on top of that, is above £200,000. £260,000. If either figure falls below those levels, the taper doesn't apply. For those it does affect, for every £2 of adjusted income above £260,000, your allowance drops by £1, all the way down to a minimum of £10,000. Now, to be fair, it's a relatively small group this touches, but if you're in that bracket, it's worth understanding before you plan your contributions. And by the way, be aware that all of these tax breaks and allowances are not set in stone and depend on your personal circumstances. One more thing worth knowing, if you work through a limited company, your company can actually pay into a pension directly on your behalf. These contributions are typically treated as a business expense, which means they reduce your corporation tax bill, and unlike personal contributions, they're not tied to your salary level, though you still need to stay within that £60,000 annual allowance. In short, a pension isn't just a savings pot, it's one of the most tax efficient things you can do with your money as a self-employed person. Now, one of the biggest stumbling blocks for self-employed people when it comes to pensions isn't the willingness. We've already established that most people want to save, it's the unpredictability of income. And that's a fair concern, because when you don't know exactly what's coming in next month, committing to a fixed monthly payment can feel risky. But here's the good news. Unlike workplace pensions, personal pensions are genuinely flexible, and you can structure your contributions to work around the way your income actually flows. Some self-employed people choose to contribute a set percentage of whatever they earn each month. So on a good month, more goes in, and on a quieter one, less. Others prefer to make one-off contributions when a big invoice lands or a stronger quarter comes in, and plenty do a combination of both. So a manageable regular amount by direct debit topped up with ad hoc payments when cash flow allows. The key point is, there's no single right way to do it. What matters is finding a rhythm that works for you and sticking to it. One mindset shift that can really help: treat your pension contribution like any other business expense, something that comes out before you start dividing up what's left. Because if you wait until everything else is covered, you'll often find there's not much left to save. So, how do you actually go about finding a pension when you're self-employed? Well, you'll need what's called a personal pension, and there are a few different types to choose from. The most straightforward are stakeholder pensions, which are designed to be simple and low cost, with a limited range of investment options. Then there are standard personal pensions, which give you a bit more flexibility and investment choice. And then there are SIPs, or self-invested personal pensions, which open up access to a much wider range of investments and give you greater control over how your money is managed. Now, SIPs have become particularly popular with self-employed people, and it's not hard to see why. First, they're flexible because you can pay in when you want, i.e. a regular monthly amount, or a one-off lump sum, or a mix of both. And for someone whose income doesn't follow a neat monthly pattern, that matters. Second, the investment choice is genuinely broad. Through a SIP, you can invest in individual shares and bonds, or in funds that give you exposure to a whole range of markets in one go, from big UK and US companies to global indices, bonds, commodities, and more. And that investment choice matters, because the size of your retirement pot isn't just down to how much you pay in, it's also down to how well your investments perform over time. But what if you don't want to pick your own investments? Well, that's completely fine. And actually, that's where a managed SIP comes in. With a Moneyfarm SIP, for example, you don't need to choose or manage the investments yourself. Instead, you're placed into a guided solution, a professionally managed portfolio built around your circumstances, including your age and retirement timeline. It starts with more growth potential when retirement is further away, and as you get closer, Moneyfarm will review your portfolio and may recommend gradually moving to a more cautious approach to help protect your savings when you need them most. Now, if you worked for employers in the past, there's a good chance you have one or more old workplace pension pots sitting dormant somewhere. Well, the good news is that you can usually transfer those into a SIP, consolidating everything into one place, which makes your pension much easier to track and manage, and can help reduce fees. And again, you can do this with Moneyfarm, which handles pension transfers for free. So to recap what we talked about, if you want to be financially secure in retirement when you're self-employed, the onus is on you. So be sure to put some thought into this. Take advantage of the tax breaks that come with pensions, because that will give your retirement savings a boost. Don't delay, because the earlier you start, the more time your investments have to grow. And remember that small amounts can mount up over time, whether added regularly or on an ad hoc basis. And finally, choose a pension that's right for you and make sure your investments are working as hard as they can towards your future. And there you have it, everything you need to start building your retirement pot as a self-employed person. If you found this video useful, please subscribe to the channel and have a look at the description below for more information on Moneyfarm. And as always, I look forward to seeing you in the next video. Bye bye for now.